You believe gold is the safest place to put your money. What if the gold market you are investing in is not entirely real? In this video, you are going to discover how the gold futures market operates at a scale that many retail investors never fully understand. Where, according to publicly available exchange data, paper contracts representing gold far exceed the physical metal available to back them. You will see how institutional traders have used this structure to their advantage, how regulators have confirmed cases of price manipulation, and why the 2011 gold peak left millions of ordinary investors holding losses they are still recovering from today. This is not a prediction about where gold is going. This is an educational examination of publicly documented facts about how the gold futures market actually works. Because the gap between what retail investors believe they are buying and what the market actually delivers has, on multiple occasions, been measured in billions of dollars. To understand where we are today, you need to go back to 1944. At Bretton Woods, 44 nations agreed to anchor the global financial system to gold at a fixed price of $35 per ounce. Every dollar in circulation was, in theory, backed by physical metal held in American vaults. It was the ultimate promise, currency with weight behind it. By the 1960s, that promise was fracturing. The United States and 7 European central banks formed the London Gold Pool, a coordinated effort to defend the $35 price by selling physical reserves into the open market whenever demand pushed the price higher. For years, it worked. To outside observers, gold looked stable, controlled, reliable. What was invisible was the rate at which sovereign gold reserves were being depleted to maintain the illusion. On March 18, 1968, the London Gold Pool collapsed. The participating central banks had spent over $3 billion in reserves and could no longer hold the line. The fixed price was abandoned. The lesson embedded in that moment, that artificial price controls on a commodity backed by finite physical supply cannot hold indefinitely, would be repeated. But markets have short memories. Over $3 billion in sovereign reserves consumed in a failed attempt to control a single commodity price. The modern COMEX gold futures market grew from the ruins of that era. It offered something genuinely useful, a mechanism for miners, jewelers, and industrial users to hedge against price swings without physically moving metal. A mining company could lock in a selling price months in advance. A manufacturer could secure supply costs. The futures contract was a tool, and tools can be used in more than one way. What the market became over decades is something that some analysts argue operates at a scale disconnected from physical reality. According to publicly available COMEX data as of 2023, the exchange trades approximately 27 million ounces of gold in futures contracts on a single day. The total registered physical gold held in COMEX vaults on the same day, fewer than 300,000 ounces. That is a ratio exceeding 90 to 1. Paper claims to gold vastly outnumber the gold available to honor those claims if holders demanded delivery simultaneously. The exchange and its defenders point out that futures markets are not designed for mass physical delivery. Most contracts are settled in cash, and that is the intended mechanism. Critics counter that this structure means the price discovered on COMEX is determined primarily by paper trading activity rather than physical supply and demand. Both positions are publicly documented. The tension between them is where risk lives. Here is what changed everything for retail investors. The realization, delivered by crisis, that holding a futures position or a futures adjacent account does not give you the same legal protection you believe it does. In October 2011, MF Global, one of the largest futures brokers in the United States, filed for bankruptcy. When administrators moved in, they discovered that approximately $1.6 billion in client funds, including gold futures accounts, had been transferred to cover the firm's own trading losses. Those accounts were supposed to be segregated, legally protected, untouchable. They were not. Thousands of clients waited months to recover partial amounts. Some never recovered everything. $1.6 billion in supposedly segregated client funds, frozen in a single broker collapse. The MF Global collapse arrived in the same year. Gold hit its historic peak of $1,921 per ounce in August 2011. That peak drew in enormous numbers of retail buyers, individuals who had watched gold climb for a decade and concluded the direction was permanent. Over the following 4 years, gold declined approximately 45%. In 2013 alone, gold suffered its worst annual decline in 32 years, falling 28% in a single calendar year and wiping an estimated $500 billion in value from gold-backed assets globally. While retail investors absorbed those losses, a separate story was unfolding inside the institutional layer of the same market. Between January 2015 and August 2018, Deutsche Bank paid $60 million in fines after admitting to manipulating gold and silver futures prices on the COMEX exchange through a practice known as spoofing, placing large orders with the intention of cancelling them before execution for the purpose of moving prices artificially. This was not an allegation, it was an admission, confirmed by regulators, with a documented penalty attached. Spoofing distorts the price signals that every participant in the market, including retail investors, making long-term allocation decisions, uses to evaluate value. No regulator has found that all institutional activity in gold futures constitutes manipulation, but the confirmed cases establish that the practice existed, was systematic, and occurred across multiple years. The structure that enabled all of this, the 90-to-1 leverage ratio, the legal gaps in segregation protection, the confirmed price manipulation, did not emerge by accident. It emerged through decades of regulatory evolution, institutional innovation, and a retail market that, according to many financial educators, was never fully informed about the difference between owning gold and owning a paper claim on gold. The lesson that publicly documented history offers is specific. The price you see on a gold futures screen is not simply the market price of a physical metal. It is the output of a system in which paper volume dominates physical supply. Institutional participants have demonstrated a willingness to manipulate that output, and the legal protections available to retail participants have, under tested conditions, proven incomplete. That does not mean gold has no place in a portfolio. It means the due diligence required to understand what you are actually holding and what protections you actually have is more demanding than the marketing around gold typically suggests. I want to ask you directly, if you hold gold, do you own physical metal in your possession, an ETF, a futures position, or something else? And did you know the legal difference between each of those before today? Tell me in the comments, because the answer matters more than most investors realize.